Dear students, welcome to my channel, Dr. V.R. Pudili, Professor of Management and Economics. In this video, I am dealing with different definitions of financial management and different decisions of financial management, including investment decision, financing decision, and dividend decision. Dear students, in this slide, I had dealt with important definitions of financial management. According to Gutman and Dougal, financial management is the activity concerned with planning, raising, controlling, and administering of funds used in the business. According to Isra Solomon, financial management is concerned with efficient use of an important economic resource, namely capital funds. It is the study of problems involved in the use and acquisition of funds. According to Massey, financial management is the operational activity of a business that is responsible for obtaining and effectively utilizing the funds necessary for efficient operations. Dear students, to conclude, we can say financial management deals with bringing of funds for business, spending of funds in business, and finally deal with the distribution of profits in an efficient manner so that owners or shareholders' wealth is maximized. To put in simple words, financial management deals with bringing of money into the business and spending of money in the business, and after every financial year it will also help us in distributing profits of the business among the owners or shareholders of the business. In this diagram, I had shown major decisions of financial management in a clear way. Financial management can be divided into three important decisions. 1. Investment decision, 2. Financing decision, and 3. Dividend decision. Investment decision can again be divided into two sub-decisions, namely 1. Capital budgeting and 2. Working capital management. Let us discuss with different decisions of financial management one after the other. The first decision is investment decision. Investment decision refers to selection of assets which can be acquired by business or company. Assets which can be acquired by company are of two types. They are 1. Long-term assets and 2. Short-term assets. Dear students, for doing business or for starting company, these two assets are very essential. Long-term assets are those assets which give return over a long period of time for business. These are also known as fixed assets. These include land, building, machinery, and equipment. Investment decision of acquiring long-term assets is known as capital budgeting. Capital budgeting decisions are also known as projects. Short-term assets are popularly known as current assets. Current assets are those assets which can be converted into cash within 1 year. In order to distinguish current assets clearly from long-term assets, I had given a broad definition here. Current assets are those assets which in the normal course of business convertible into cash without diminution in value within a year without disrupting the business operations. Dear students, if you want to sell long-term assets or fixed assets, for example, if you want to sell land, building and machinery, within a year, you have to decrease the value. And if you sell these long-term assets, you have to stop the business operations. And at the same time, if you want to sell the fixed assets, it is not the part and parcel of the business. Selling current assets is normal course of the business. Generally, in any business, we sell the finished goods. So that's why current assets are defined very broadly. Current assets include cash, inventory. Inventory includes raw materials, semi-finished goods, and finished goods, and receivables. Investment decision of managing short-term or current assets is known as working capital management. As I already told you, investment decision can be again divided into two sub-decisions, one capital budgeting and two working capital management. Let us now discuss with capital budgeting. Capital budgeting refers to selection of an asset or investment proposal or course of action whose benefits are likely to be available in future over lifetime of the business. Examples of capital budgeting decisions include purchasing of land or site for starting the business, constructing building or shed for business, buying equipment for business, going for global level business, merger, acquisition, investment proposal in R&D, outsourcing proposal. All these are the examples of capital budgeting decisions. Dear students, some students may not have an idea about merger and acquisition. Merger means combining of two or more companies or businesses. Acquisition means getting some substantial control over one company by another company. In capital budgeting, measuring net worth of the proposal or asset is crucial. We generally select an asset or proposal with the highest net worth. For measuring net worth, we use different techniques or models of capital budgeting. For simple understanding, net worth is the difference between benefits and costs of an asset or a proposal. We employ two kinds of techniques in capital budgeting, namely traditional techniques and modern techniques. Traditional techniques include payback period method and accounting rate of return method, popularly known as ARR. Traditional methods are also known as non-discounting techniques because these techniques do not take time value of money into consideration. Modern techniques of capital budgeting include net present value, shortly known as NPV, internal rate of return, shortly known as IRR, and profitability index method, which is also known as benefit cost ratio method. These modern techniques are also known as discounting techniques, as these techniques take time value of money into consideration. We use discount rate, technically known as cost of capital, in modern techniques of capital budgeting for making capital budgeting decisions. The second investment decision is working capital management. Working capital management deals with the management of current assets. There are two important concepts of working capital, namely gross working capital and net working capital. Gross working capital refers to total current assets. Net working capital refers to difference between current assets and current liabilities. Under working capital management, we deal with how to compute working capital requirements for a business and what are the different sources of financing working capital requirements of the business and determinants of working capital requirements in the business. We also deal with cash management, inventory management, and receivables management under working capital management. The second major decision of financial management is financing decision. Financing decision deals with financing mix or capital structure or leverage. Financing mix or capital structure means combination of debt and equity. Debt refers to borrowed funds or outsider funds brought for doing business. Equity means owner's funds. Debt is cheaper than equity and requires fixed return only in the form of interest. But doing business with abnormal debt is risky. Equity is costlier than debt. Return to equity increases with profits, and more equity partners in business leads to less control over business. That means both equity and debt have their own advantages and disadvantages. Financial manager has to decide a best combination of these sources of funds and should procure the same for business. In other words, he should decide optimum capital structure for business. Under financing decision, we do EBIT and EPS analysis to determine optimum or best capital structure for business. We also find whether leverage is favorable or not by using DOL and DFL concepts. Dear students, we will deal with the concepts that I have used here later in detail. For now, let us understand only the meaning. EBIT means earning before interest and tax, which is popularly known as operating profit. EPS means earning per share. DOL means degree of operating leverage. DFL means degree of financial leverage. And leverage means the decision or process of using debt in the capital structure is simply known as leverage. Let us learn about these concepts in different videos that will be done by me in future. In traditional mode, we learn capital structure theories under finance decision, including net income, net operating income, Modigliani-Miller theory, and traditional theories. The third important financial management decision is dividend decision. Dividend decision is also known as profit management decision. There are two alternatives available for a financial manager while dealing with profits, namely, one, whether to distribute profits to owners in the form of dividends or to retain profits in business to invest again for expanding the business. Simply, whether to distribute profits to the owners, that is one decision. Two, whether to retain the earnings for reinvestment purpose in the business. The choice of financial manager depends upon various factors known as determinants, which include preference of the owners and expansion opportunities available for business. Under dividend decision, we learn about various types of dividends, various dividend policies in practice, and determinants of quantity of dividend in practice. In traditional mode, we learn about dividend theories under dividend decision, which talks about theoretical aspects of dividend, including Walter, Gordon, and Modigliani-Miller models. Dear students, in this video, we had learned about different definitions of financial management and different decisions of financial management, including investment decision, financing decision, and dividend decisions. Thank you.